Good afternoon. This is Craig Modelmog with another episode of Wall Street X's and O's. Today's Friday, February 5th. Yes, we are still alive. It's good. I will first of all like to thank everyone for their thoughts, their prayers, all your kind words, and whatnot. It means a lot. But quick update: Ton did end up contracting it, so I'm glad she loves me and she hasn't told me to pack my stuff and leave yet. So obviously I am the cause of this, but we've both been laying very, very low this week. I can honestly say I've never been so sick where I didn't want to do anything. In 27 years of doing this job, I've never had this much time off. I'll be honest with you. It's been really crazy, kind of a eye opener as to the severity of what this can be. And I think for Ton and I, it's something we had a little bit rougher of a go, but we're on the mend. I will probably be back in the office spotty starting Monday. Ton cannot go back in until Friday, based on Larimer County Health. So anyway, so that's kind of the story and the update. To kick things off here, we're going to talk a little bit about the labor markets, which are very interesting. We're going to talk about the global economic slowing that's been taking place the last 2 months. Nothing major. The economy globally still shows a very significant amount of resiliency. We're going to talk about the adaptability of humans with this whole COVID thing, and then I'm going to close it up with just kind of an update on what's the data showing, what's it saying. And like I said, things so far are looking really good. But labor markets are struggling a little bit. I think there was a lot of optimism just in general and also in the markets as we ended last year, moving into this year. I think the labor markets have started to show signs of deterioration going back in December, where we saw a negative revision for December of 87,000. So there was a total number of lost jobs in December of 227,000. If you look in January, we only posted 49,000 new jobs. They were expecting, or there was an estimate of about 105. Not quite sure who was that optimistic with everything going on, but they were, and it's not a big deal. I think all this is going to do is really add some fuel to the Democrats wanting to get this new stimulus deal passed. Because the size of it, which it's big, which that's been the kind of the rebuttal on the Republicans as well. It's too big. We're giving it to too many people. I think the Democrats view it as we need to create a bridge or a gap to bridge the gap on what's going on, excuse me, in the labor markets, because we're not seeing those come back quite as quickly because we're seeing obviously COVID shutdowns globally. We're seeing them continue to be challenged here in the United States. We do have vaccines rolling out, and honestly, until we get vaccinations widespread, until we get the labor markets fully starting to re-engage, to see the real power of what's coming may take a little bit of time. So I think they view this as just a gap. They're trying to bridge the gap from when all of this begins to happen. So that when you kind of look at it, it to me is kind of how I view their logic behind it. And honestly, it probably makes some sense. There are a lot of people that need this, and it's not their fault with what's happened, and they need to do something. To what degree, that's not my business to poke at that, but that is kind of what I think. Moving on the payroll side, here's an interesting thing. When you really look at the numbers from the non-farm payrolls, okay, which tracks all the new jobs that are being created. The problem that we have, there's not a labor demand problem. There's lots of people out of jobs. There's lots of people underemployed. The problem is we have a labor supply problem. And you see, all that goes back to, again, with COVID and what's happening. Companies are not reopening at the speed that they would like to because there's not anything generating it. Okay, this pent-up demand thing, I think is a bunch of bunk, because I don't know about you all, but for people that are used to going out to eat, and say you went out to eat twice a week, and I'm just making this up for illustration purposes, you look at how many months we have not been going out to eat twice a month or twice a week, okay, just because things start opening doesn't mean you're going to be like, hey, you know what? We're going to go out to eat for breakfast, lunch, and dinner now because we have to catch up. Um, that's not going to happen. So again, the challenge is labor supply. So until the labor supply really comes back on to the margin, I think things are going to be slower to go. We're seeing positive things out there, and things are actually really good, but it's something that it's going to take time, and we've got to continue to be patient. Okay, looking at global growth, we saw just a modest slowdown as we moved into December of 2020 and then into January of 2021. Nothing really to write home about. It's not a concern. It's just more an observed fact, an observed data point. Okay. But it's definitely something we're going to keep our eyes on. But I really do look for things to start to kind of reignite here. I think we're going to see a GDP number in this country that we have not seen since World War II. It would not shock me to see north of 10% in a GDP number in the United States. Japan's going to show a good GDP number. Germany should show a halfway decent GDP number. So all these things are going to be start to be the driver on the short run with the markets. Looking at the adaptability of humans, and here's an interesting. I was reading a research report, and it says that. And I lost my spot for those of you. I didn't even do my disclaimer. See, I'm just like I'm just out of sync right now, but we'll throw the disclaimer at the end here. But if you look at it, you saw COVID cases begin to taper in January, okay? And this was through most of the world's economies. Even so, with the weekly momentum is still well above levels observed this summer and this fall, the fact that the economic activity has not deteriorated more speaks to the resiliency and adaptability of humans. Analysts continue to grossly underestimate this economic resiliency in nearly all parts of the world, according to the Citigroup Economic Surprise Indexes. So I think what you're seeing is we as people figured out. We're very adaptable. Even when I think we are soft as Americans, I think we are showing the ability to adapt and to handle what's going on, and I think that's a big plus. But and then segueing into that, when you look at what's happening right now, I think that the White House doesn't have as big of an impact as we think. Both parties have these feelings. When the other party comes into power, you always have these concerns, and it happens on both sides. That's normal. But I think what we're seeing is it's not as big of a deal as we think. Because if you think about this, everyone in DC is a politician. Okay, I'm going to be a political cynic here for a minute, and they have one major focus, and that's to get reelected. Let's just call it what it is, right? So you have to know that nobody, regardless of party, regardless of which side of the aisle that they reside on, they are not going to blow this economy up. Okay? They're not going to raise taxes and do all this crazy stuff because they can't jeopardize an economic downturn, because that would hurt them, especially going into midterm elections. Because now the big talk now is already midterms, which is crazy. It's like, well, shoot fire. We just swore in President Biden and his people, and now they're already talking midterms. So you have to know that they're not going to blow themselves up, because the midterms are crucial. So you have to know that and have confidence in that. They are not going to kill the economy intentionally. Okay? So I'm confident of that. When you look at the stimulus that's coming in, you know what? What did I tell you? That we were going to have volatility that's going to continue to drift downwards. We're going to see growth start to continue to accelerate. We're going to see inflation continue to accelerate, and we're going to get stimulus. That's what I said going into the end of last year. That's exactly what's happening. And what are you seeing with the markets? The markets continue to set new highs. So positioning wise, we have to continue to be exposed to equities, because you can't miss these opportunities, and that's exactly how we're set up right now. If you look at it, the data and the math really does drive the markets at the end of the day. The profit cycles right now are looking strong. Historically, cyclicals and small cap tend to perform very well in an environment like this. Thus, that's how we are positioned. And profit cycles fuel sector, size, and style rotation. And we are really setting in a nice spot right now, and we will continue to monitor and evaluate how things continue to change and how things continue to accelerate or decelerate, because that drives our risk management process. Okay, you have to embrace the market cycle, not the story. Okay, there's so many people that are so dialed into listening to a story, listening to the narrative, and they forget to remind themselves that the data and the math is what drives it. And we've seen Wall Street, which I think last week, with all this garbage going on with GameStop, among lots of other companies with very high levels of short interest, we saw Wall Street really kind of go into a period where they were really repositioning portfolios. The last time we saw that, we saw a big one in 2016. The most recent one was March of 2020. So you're seeing institutions and hedge funds really now begin to position on the long side of equities. And you know what? We've been there. We're going to continue to be there, and we're going to continue to front run them and really do well and take advantage of the opportunities that present themselves. Okay. So in closing here, first of all, appreciate everyone showing up for these. They're a lot of fun. I hope they're helpful. My goal is, again, to help people become better investors, help people understand what is going on, and to ignore the narratives out there because they're not helpful. Everything that is on this show, as you all know, is not to solicit anything. It's not to solicit a buy or a sell. It's mainly my opinions only. It is backed and supported by nothing but facts, because you know that's something I'm very, very passionate about. Investments can and will lose money, and they are not FDIC insured. So there we go. Hey, we're just flipping it around. Normally that comes at the front. It's the end here. I tell you what, again, for Friday, February 5th, I appreciate all your guys' support of Tanya and I, and all is well. Everyone enjoy your weekend. And without further ado, I am out.